$5,600 an ounce. That's where gold peaked earlier this year, right before it crashed 30%. Then it ripped back 15% in a matter of weeks. And here's the wild part. One free government report basically flashed the warning signs before that top. Today, I'm breaking down whether gold is still worth owning right now, the smartest ways to own it through a U.S. brokerage account, and the exact positioning signal the pros track every single week. Let's get into it. First, let's set the scene, because 2026 has been a roller coaster. COMEX gold punched through $5,600 an ounce early in the year. Then hot jobs and inflation data flipped the Fed hawkish, and gold tanked a peak-to-trough drawdown of roughly 30%, bottoming near $3,970. Then, from mid-July, it rebounded about 15%, climbing back toward 4,600 and reclaiming its 200-day moving average. And here's a key tell. Global gold ETFs flipped from net outflows to net inflows. Institutions started buying the dip. Now, here's what most people miss about how gold is actually priced. For nearly 2 decades, from 2003 to 2021, gold moved almost tick for tick against U.S. real interest rates. The correlation was around negative 0.85. Real rates up, gold down. Simple. Then 2022 changed everything. Central banks started buying gold hand over fist, and that single factor came to explain more than 60% of price moves. Add geopolitical hedging on top, and you get a twin-engine model, central bank buying plus safe haven demand. But here's the twist in 2025 and 2026. The old real rate relationship came roaring back, with an R-squared near 0.8. So right now, gold is tightly anchored to Fed policy and real yields, and that means violent swings in both directions. So what's keeping the bulls in charge? 3 big pillars. Number 1, America's debt bomb. U.S. public debt has blown past $40 trillion, and net interest payments now exceed the entire defense budget. When investors start questioning whether treasuries are truly risk-free, gold's value as a credit hedge goes up. Number 2, central banks keep buying. In the second quarter of 2026, they scooped up a net 289 metric tons, a record for that quarter. China's central bank alone has now added gold for 21 straight months. This is strategic, counter-cyclical buying. They buy weakness. They don't chase strength. Number 3, geopolitical uncertainty isn't going away, and that keeps a floor under safe haven demand. But let's be honest about the risks. If inflation proves sticky and the Fed starts hiking again, the cost of holding gold, which pays you nothing, goes up. If long-term Treasury yields stay pinned at high levels, the whole bullish driver flips. Valuation markers like the gold-to-oil ratio and the gold-to-silver ratio are sitting at historical highs. And when speculative positioning gets this crowded, one wave of profit-taking can snowball into a 4 to 10% flush, sometimes worse. And remember the history. After the 1980 and 2011 tops, gold entered long, grinding bear markets. The good news? History shows you'd need all 3 core pillars: monetary policy, central bank buying, and dollar credit to reverse at the same time to trigger a true bear market. So where do the big banks think gold goes from here? Goldman Sachs is targeting roughly $4,900 by the end of 2026. UBS is more bullish at $5,400. More conservative forecasts see the fourth quarter landing between $4,400 and $4,600. Take every one of these with a grain of salt. Forecasts live and die by their assumptions. Here's the bottom line from the research. The big macro drivers behind this bull market: dollar credit repricing, central bank accumulation, runaway debt, have not fundamentally reversed. So this year's beatdown looks more like a mid-bull correction. Think 1975 to 76, or the 2008 pullback, not a 1980 or 2011 style top. And history says these mid-cycle corrections can run 30 to 47% deep, and they've typically been long-term buying windows, not trend endings. Gold still earns its place as a medium to long-term allocation. But short-term volatility is elevated, so blindly chasing rallies here is a bad idea. Okay, so you want exposure. What are your options? For most U.S. investors, gold ETFs are the cleanest play. Think funds like GLD, that's SPDR Gold Shares, or IAU, the iShares Gold Trust. You can buy them in any brokerage account: Fidelity, Schwab, Interactive Brokers, Robinhood, wherever you trade. Expense ratios run roughly 0.15 to 0.6% a year, with all-in costs still under 1%. Liquid, transparent, no storage headaches. The trade-off: you're holding paper, not metal, and small tracking differences exist. Some investors also look at gold mining stocks or the GDX ETF for extra torque. Just remember, those are equities with company-specific risks, not pure gold exposure. If you want the real thing, you can buy bars and coins through established U.S. dealers. Expect a premium of roughly 1 to 3% over spot when you buy, and a haircut when you sell. Physical makes sense for long-term holders who want true crisis insurance, but storage, authenticity, and wide sell spreads are on you. For experienced traders, COMEX gold futures and options offer the lowest trading friction and two-way bets, but leverage magnifies losses just as fast as gains. That lane is not for beginners. And one warning: gold jewelry is not an investment. Premiums of 20 to 30% over melt value, plus steep discounts on resale. That's consumption, period. Now let's talk strategy. And first, understand gold's actual job in your portfolio. It's a ballast, not a growth engine. Get this: from 1802 to 2001, gold's after-tax real return was roughly zero. Over the very long run, it basically just offsets inflation. But when inflation runs hot, like 1966 to 1981, real returns hit 8.8% a year. In low inflation eras, it lags badly. So the mainstream recommendation, echoed by shops like Bridgewater, is 10 to 15% of investable assets in gold as a defensive allocation. Its low correlation with stocks and bonds is the whole point. What about silver? More upside torque, sure, but it's heavily industrial with weaker safe haven credentials. Keep it under 20 to 30% of your precious metals sleeve. And if you're pairing gold with a little Bitcoin, know this: under real market stress, Bitcoin tends to move with risk assets. It's a weaker stabilizer than gold. Let me give you a simple 3-step framework the institutions use. Step 1. Macro sets the long-term trend. Watch dollar credit, Fed policy, and whether central bank buying continues. Step 2. Assess allocation value against the cycle. In a recession to recovery path, expect max drawdowns around 15 to 20%. In an overheat to stagflation path with aggressive hikes, drawdowns could exceed 20%. Step 3. Manage the short-term swings. When the long-term trend is up, a single negative catalyst typically means a 0 to 5% pullback within a month. Multiple negatives at once? Think 10 to 15% over half a year. The playbook. Get aggressive when drawdowns hit 5 to 10%. All right, now the star of the show, the tool that helps you time those entries. It's called the COT Report, Commitment of Traders, published weekly by the CFTC, the U.S. futures regulator. Think of it as an X-ray of the gold futures market. The report splits positioning into two camps: commercials, the hedgers, and non-commercials, the speculators, hedge funds, and commodity trading advisors, or CTAs. The number that matters most is the speculative net long percentage, non-commercial longs minus shorts, as a share of positioning. Here's why it's powerful. It tells you both your win rate, how hot sentiment is running, and your odds, whether positioning is stretched to an extreme or the crowd is about to flinch. Here's how to read it. When the net long percentage climbs above its rolling 5-year average, plus 1 standard deviation, and especially past plus 2 standard deviations, the market is overbought. Follow-through buying dries up, profit-taking pressure builds, and gold tends to enter a choppy, high-volatility plateau or an outright correction. Flip it around. When net short positioning gets extremely heavy, downside gets limited, that crowd becomes fuel for the next rally. And this isn't theory. After COMEX speculative net longs broke above that plus 1 standard deviation line, gold entered extended high volatility plateaus twice in recent memory, from June 2016 to September 2017, and again from March 2020 to October 2021. Now look at this data. This is where it gets really interesting. In the week of December 10th, 2024, the speculative net long percentage hit 57%. That was higher than 98.9% of all readings since 2015, 2.1 standard deviations above the 5-year mean. And it stayed above the plus 1 standard deviation line for 16 straight weeks. By the week of April 15, 2025, it had cooled to 44.3%, still historically high, above roughly 80% of readings since 2015, but down to about 0.6 standard deviations above average. Translation: the odds were improving even as the win rate was fading. Crowding was easing. Fast forward to 2026. In late July, non-commercial net longs sat around 320,000 contracts, the 85th percentile of the past 5 years. Then, the week of August 18th, speculative net longs reached roughly 146,000 contracts, and global gold ETFs added 340,000 ounces in a single week. The last time positioning got that crowded? Right before gold's interim top in January 2026, and a correction followed. So how do you actually use this? 5 quick rules. 1. Check the COT data every week. It's free on the CFTC website, and focus on non-commercial net longs. 2. Compare the current reading to its rolling 5-year mean and standard deviation. Most research platforms publish standardized versions. 3. Never trade the COT alone. Cross-check it with ETF flows. Options call positioning. Heavy call buying can force dealer hedging that acts like a price amplifier in both directions, plus the dollar index, real rates, and geopolitical headlines. 4. When net longs stay pinned at extreme highs for weeks, stop chasing and consider trimming in batches. When positioning normalizes but the macro story is intact, that's your dip buying window. And 5. Respect the lag the report drops on Fridays covering earlier data, so always combine it with live price action and news. Before you run off, let's rapid-fire the biggest mistakes gold investors make. Mistake 1. Treating central bank buying like speculative hype. It's not. It's strategic. counter-cyclical accumulation. Mistake 2. Only watching the Fed. Since 2022, central bank demand has been a dominant driver. Mistake 3. Assuming gold always hedges. In a true liquidity crisis, investors sell whatever they can, even gold. The safe haven can temporarily fail. Mistake 4. Anchoring on one bank's price target or one shiny backtest. Mistake 5. Ignoring COT extremes and buying into euphoria, the exact trap this framework protects you from. Mistake 6. Confusing gold mining stocks with gold itself. Miners are equities with operating risks, they are not bullion. And mistake 7. Ignoring transaction costs. Spreads and premiums eat returns alive. All right, let's turn all of this into an action plan. Step 1. Know yourself. Your risk tolerance, your time horizon, and how much gold you already own. The goal is defense and diversification, not lottery tickets. Step 2. Pick your vehicle. For most people, that's a low-cost gold ETF. Want metal in hand? Buy standard bars or coins from reputable dealers. Skip the jewelry counter. Step 3. Pace your entries. With prices elevated and volatility rising, build positions in batches or dollar cost average. Watch for those 5 to 10% pullback windows to add. And track the COT report weekly so you're never the last one buying at peak euphoria. Step 4. Keep your dashboard updated. Fed policy and real rates, central bank buying data, U.S. debt dynamics, and futures positioning. Step 5. Control risk. Don't over-concentrate in any single asset. Leave futures and options to experienced hands, and rebalance on a schedule. So here's the final takeaway. The forces powering gold's long-term bull market, $40 trillion of debt, relentless central bank buying, a repricing of dollar credit are still standing. That suggests this year's crash was a violent mid-cycle reset, not the end of the run. But with positioning this jumpy, the path higher won't be a straight line, and the investors who win are the ones watching the data, not the headlines. So what do you think? Is gold headed to 5,400? Or does another flush come first? Drop your take in the comments, and if this breakdown helped, hit like and subscribe for more. Quick disclaimer, this video is for educational purposes only and is not investment advice. Gold is volatile. History doesn't guarantee the future, and you should always consult a licensed professional before making any decisions. Thanks for watching. I'll see you in the next one.